study changes the entire investment thesis. Let's look at the
But if you stop at the price you was $35.54 million.
Standard market maker behavior.
Yeah, the number on the screen for Recursion Pharmaceuticals, inflating side of a speculative AI. Look at the business side. The Q4 revenue beat was
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
$3.67. That is the number on the screen for Recursion Pharmaceuticals, ticker RXRX, as we close out late February 2026. And I want to sit with that number for a second because it tells a fairly brutal story. We are trading significantly below the 50-day moving average of $4.20. We are miles below the 200-day moving average of $5.08. If you are a technician, you know, the chart just looks broken.
It looks like a falling knife, honestly.
It does. It really does. But if you stop at the price, you miss the actual mechanism at play underneath it all. I want to look at the dark pool volume intensity. In late February, 66.52% of the total volume was concentrated between $3 and $3.05. That's institutional level volume happening entirely off the lit exchanges. Someone is transacting heavily right at these lows.
Right. Or someone is distributing. If we are going to look under the hood at that volume, we absolutely have to talk about the short side of the equation, because that is where the immense pressure is coming from. The FINRA short volume data for late February is just relentless. We are talking about between 37 and 48% of all off-exchange volume being short selling.
Nearly half the volume.
Exactly. Half the volume. We are looking at a total short interest of 173.17 million shares. That is 34.42% of the available float. Just for context for our listeners, anything over 10% is generally considered high. 34% is a crowded room with the doors locked. And the days to cover ratio is sitting at 8.8. That means at current volume, it would take bears nearly 9 days of constant buying to cover their shares. That is a massive, crowded bet that this company is effectively going to zero.
It is crowded and I would argue incredibly dangerous for the bears. But that data really sets the stage for the central question we need to unpack today. Is Recursion Pharmaceuticals truly the tech bio revolution we were promised? Is this the company that is effectively industrializing drug discovery? Or, as those massive short numbers suggest, is it just a cash-burning machine caught in the deflating side of a speculative AI bubble?
Yeah, it's the classic growth paradox.
Right. And my position today is clear. I believe Recursion has reached a critical inflection point. The narrative has fundamentally shifted. For years, we talked about, building the platform. Now, we're seeing AI-generated hypotheses finally translating into proven clinical benefits. The data validates the method.
And I come at it from the exact opposite side. I look at the valuation and I see a complete disconnect from the fundamentals. You see an inflection point, I see a single small-scale study being used to justify massive net losses. And frankly, the market, along with some very smart strategic partners, seems to agree with me. When you have a net loss of over $600 million and your key AI partner, Nvidia, heads for the exit, that is not a validation. That is a warning sign flashing neon red.
Look, I see why you emphasize the financials and the partners, and we absolutely have to unpack the Nvidia situation because that is the elephant in the room here. But I want to start with the clinical reality, because for years, the bear case against Recursion was always that it was just a science project. Great maps, beautiful images, cool supercomputers, but no actual drugs. The fourth quarter of 2025 changed that narrative entirely. We have to look at the Tupelo study data for REC-4881.
Right, this is the treatment for FAP, familial adenomatous polyposis.
Correct. It's a genetic disorder where patients develop hundreds, sometimes thousands of polyps in the colon, leading almost inevitably to cancer. It's a horrific condition with very few options other than major surgery. Now let's look exactly at the data Recursion produced. In 12 evaluable patients, 75% showed a reduction in polyp burden. The median reduction was 43%.
Okay, but let's just pause on 12 patients. That is an incredibly tiny sample size. You simply cannot build a multi-billion-dollar valuation on the backs of 12 people.
It is standard for a rare disease phase 2, but hold on, the sample size isn't actually the headline here. The headline is the off-drug durability. This is the key biological insight that I think the broader market is completely missing. 12 weeks after stopping the therapy, the median reduction in polyps actually deepened to 53%.
Wait, so they got better after they stopped taking the drug?
Exactly. That suggests the disease progression wasn't just paused while the drug was in their system. It was fundamentally altered. The biology was reset. That is the holy grail of disease modification. And on top of that clinical win, look at the business side. The Q4 revenue beat was $35.54 million, compared to just $5.2 million in Q3. That proves the partnership model with Roche and Sanofi isn't just a PR stunt. It is generating real, non-dilutive capital.
I hear the enthusiasm, but I just don't buy that this one isolated study changes the entire investment thesis. Let's look at the other side of the ledger for a moment. You mentioned partners generating revenue, but the market is voting with its feet. Nvidia completely divested their 7.71 million share stake.
They did sell out, yes.
Every single share, gone. This is the premier AI hardware company in the world. They know more about AI infrastructure and compute scaling than anyone else on the planet. They were an early believer in Recursion. If this company is the AI-native future of drug discovery, why is the king of AI selling out entirely? It just doesn't add up. If the tech was that transformative, if the Recursion OS was truly the future, Jensen Huang would be doubling down, not walking away.
It definitely raises eyebrows. I won't deny that.
And financially, despite that revenue bump you mentioned, the company posted a net loss of $644.76 million for the year. The EPS, the earnings per share, is negative $1.44. You are burning $500 million to generate $35 million in revenue for the quarter. That math simply doesn't work long term. You can't make that up in volume.
The loss is substantial, I grant you that. Building an industrialized platform is capital intensive. But let's go back to the Tupelo study, because you dismissed the sample size a bit too quickly, and I think that's where the fundamental misunderstanding lies. You are extrapolating a lack of success from the financials, but I am extrapolating success from the method itself.
But again, 12 patients.
It's not about the 12 patients. It's about the origin of the molecule. The Recursion OS, their operating system, identified a highly non-obvious biological relationship. It found that MEK1/2 inhibition could treat FAP. Traditional biology completely missed that. Human intuition missed that. The AI found it hidden in the noise of millions of cellular images. The success of REC-4811 validates the method, not just the molecule.
So your core argument is that because the map worked once, it will automatically work every single time.
No, my argument is that the map has been pressure tested in the real world. If the map was right about FAP, a complex genetic condition, it significantly de-risks the rest of the upcoming pipeline. Specifically, we have REC-1245, the RBM39 degrader, and REC-994. Both of these have readouts coming in 2026. The platform has proven it can navigate biology to find a clinical truth. That is what you are buying at $3 a share. You aren't buying a FAP drug. You are buying the engine that discovered it.
That is a very compelling narrative, and I know that is exactly what's in the pitch deck. But have you considered the massive risk of extrapolation here? You are taking a win in a gastrointestinal condition, polyps, and assuming it naturally translates to complex solid tumors or cerebral cavernous malformation. Those are completely different hostile biological environments.
Biology is complex, sure, nobody is denying that.
It's infinitely complex, and the market seems to share my skepticism on this. Just look at the technicals we started with. Despite this so-called good news regarding FAP, the stock is locked in a falling trend. It's making lower lows. If the Tupelo data was truly the Rosetta Stone of biology, like you're implying, the stock wouldn't be languishing at $3. The market has priced in this minor win and is loudly asking, okay, what else and at what cost?
The market pricing right now is highly inefficient, largely because of the short pressure we discussed at the very top. But let's actually talk about who is holding the stock, because the smart money story is much more nuanced than just Nvidia leaving. You framed Nvidia leaving as a death knell, but let's look at the actual register.
Is it more nuanced, though? It's not just Nvidia heading for the exits. Nova Holdings reduced their stake by about 18%. UBS Asset Management sold about 75% of their position. Morgan Stanley sold 22%. These are the early strategic backers.
These are the people who were there at the very beginning. When the people who helped build the house start taking their chips off the table, usually it means the hype cycle is maturing and the harsh reality check is coming.
See, I'm not convinced by that line of reasoning because it completely ignores who is stepping in to buy those shares. We are seeing a massive structural rotation in the shareholder base. We are moving from venture and strategic money, which, let's remember, often has strict time horizons on their funds, to institutional foundational money.
You mean the index funds?
Not just passive index funds. Look at the Q4 2025 filings. Vanguard increased their position by 18%. BlackRock added 22%. State Street added 38%. These aren't retail day traders. These are the absolute titans of asset management. And perhaps most tellingly, Norges Bank, the sovereign wealth fund of Norway, increased their stake by a massive 81%.
Norges is a significant player, sure. They have a very long horizon.
Right. They are a massive signal of long-term confidence. They don't buy into a science project doubling down like that. They are positioning for the decade, not the next quarter. And regarding Nvidia, I interpret that exit as routine portfolio realignment. The technical collaboration between the two companies is still very active. Recursion is still heavily involved in the BioNemo ecosystem. They literally have a talk scheduled together at the GTC conference in March. Nvidia selling shares doesn't mean the technology doesn't work. It means Nvidia manages its own massive investment portfolio actively. And maybe they just wanted to book a tax loss or free up cash for their own data centers.
It might be portfolio realignment, but you can't ignore it's a realignment away from Recursion. You don't sell the next Google if you truly believe it's the next Google. But let's move on and look at the fuel required to keep this AI engine running. We need to talk about the cash burn versus the runway. Because grand narratives are great, but cash is what actually pays the scientists.
The balance sheet is actually quite strong.
Is it though? You have a company sitting on a cash balance of $753.9 million. On paper, isolated, that sounds like a lot of money. But when you're burning through $600 million a year, that pile shrinks very, very fast. That is barely a year and a half of runway if they don't severely tighten the belt.
It's not just about the raw number. It's about the trajectory of the spend.
At the market shelf offering, they just filed a $300 million ATM with TD Cowen. For the listeners who might not be familiar, an ATM is essentially a corporate credit card that gets paid off by issuing new shares into the open market. It dilutes existing shareholders. You don't file a $300 million ATM if you are entirely confident your current cash pile will get you to profitability without asking the market for more help.
Or you file it simply as insurance.
It's very expensive insurance for the shareholders, and with a price-to-sales ratio sitting at 47 times, this company is extremely expensive compared to traditional biotech peers. You are paying a massive tech company multiple for a cash-burning biotech balance sheet.
I see the ATM as a tool for flexibility, not a sign of desperation. Management has been very clear about their new mantra heading into this year: momentum with discipline. Look at the efficiency metrics they've posted. They achieved a 35% reduction in pro forma operating expenses year over year. R&D expenses in the fourth quarter actually decreased by 2% to $95.9 million.
A 2% decrease is hardly an austerity measure when the absolute number is still nearly $100 million a quarter.
But it signifies control. They are doing more with less because the platform is inherently becoming more efficient. They aren't just throwing money at the wall to see what sticks anymore. Management guidance puts the cash runway extending into early 2028. That runway covers the majority of the major phase 2 readouts. They do not need to use that ATM immediately, and you are completely ignoring the non-dilutive capital coming in. They have brought in $134 million total from Sanofi, $213 million from Roche and Genentech. This is what they call the data-to-dollars flywheel. It is spinning. They are selling biological maps and hitting milestones to fund their internal drug development. That is a sustainable model that actively reduces the reliance on equity financing.
It is a model, I grant you that. But let's look at the market mechanics again, specifically those dark pools we mentioned at the top of the show. You have to ask yourself, who exactly is swimming in those dark waters? We see Citadel advisors showing up heavily in the filings.
Citadel is everywhere in these types of stocks.
They are. and they increased their equity stake by 213%, which sounds incredibly bullish on the surface. But look closer at the 13th F filings. They're holding massive derivative positions to go with it, 1.98 million calls and 1.96 million puts.
That is standard market maker behavior.
It is standard hedging. It is not pure fundamental conviction. It characterizes a market maker preparing for violent volatility, not a long-only fund betting on a cure for cancer. They are betting on the swing, not the outcome. And when you combine that institutional hedging with the days-to-cover ratio of 8.8, you have a setup where the stock is incredibly fragile. Any stumble in the clinic, any slight delay in those 2026 readouts, and that crowded trade tries to exit all at once.
Or as the exact opposite happens. That massive short interest is fuel.
Fuel for what exactly?
A short squeeze. Think about the mechanics. We have 71.9% institutional ownership. The available float is actively shrinking every single time Vanguard or Norges Bank buys more shares. The supply is drying up. Now, imagine if the new CEO, Dr. Najat Khan, delivers on the upcoming milestones. We are talking about FDA engagement for FAP in the first half of 2026. We are talking about phase 1 data for REC 2455. If that data is good, those shorts representing 34% of the float are going to be forced to cover.
If is doing a lot of heavy lifting in that sentence.
But the catalyst is there and it's imminent. Dr. Khan is intensely focused on execution. She comes from the data science and pharmaceutical strategy world. She isn't a founder with a dream, she's a seasoned operator with a plan. If she delivers, the short squeeze could be violent, driving the price up rapidly because there simply aren't enough shares available for the skeptics to buy back.
Look, Dr. Khan is certainly a capable leader, but she is inheriting a very difficult situation. Let's step back and summarize where we actually are with this. I look at Recursion and I see a company where the grand story is still vastly outpacing the clinical reality. The technology is fascinating. I genuinely love the idea of it. But as an investment, it is fraught with risk. You have exceptionally high short interest, which tells you the sophisticated money is betting heavily against it. You have the total exit of a key strategic partner in Nvidia, and you have massive ongoing net losses. The industrialization of discovery hasn't yet proven it can reliably return value to shareholders. It is a high beta, highly speculative bet, and at 47 times sales, you are paying a massive premium for a whole lot of uncertainty.
And I look at the exact same company and see the future of medicine being built in real time. Recursion has successfully moved from AI hype to clinical reality. The REC 4881 data was the definitive proof of concept that the map actually works in human patients. The transition of ownership to foundational asset managers like BlackRock provides a stable floor that simply didn't exist 2 years ago. And the cash runway extending out to 2028 gives them the crucial time they need to execute. They are doing exactly what they promised, translating digital biological maps into physical medicines. The dip we are seeing right now, it's a temporary disconnect between the share price and the actual scientific progress.
Well, 2026 is certainly going to be the ultimate test of execution for Dr. Khan and the rest of the team. There is simply no place to hide with those major readouts coming.
Absolutely. The data will have the final say, as it always does in this industry. For those of you watching the charts, keep a close eye on that $3.56 support level. That is going to be critical in the coming weeks.
And definitely watch the Phase 1 readouts in the first half of 2026. That is where the rubber meets the road. Whether this current dip is a generational buying opportunity or a flashing warning sign, well, that is something you'll have to weigh for yourself.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!